What you've seen is that the move in gold price has really occurred with very little retail participation. If you look at the statistics around physical gold ETFs, until about 5 weeks ago, retail investors in the Western world, at least, were dishoarding or selling gold. The strength in gold has been central bank buying. Now, I would agree with your statement that gold traditionally does well in the context of inflation. But what's kicked this gold bull market off, really, I think, is the weaponization of the US dollar. If, as I believe likely, that the follow through is retail participation on top of continued central bank buying, then I think, Jimmy, you see a real move in the gold price, and that's what I'm anticipating will occur.
In 2024, gold has firmly established itself as a top performer, propelled by substantial central bank purchases and increasingly challenging macroeconomic conditions. Recent data from the World Gold Council highlights an astonishing trend. Central banks have accumulated more gold over the past 2 years than in the previous 50 years combined. In 2022 alone, global reserve banks secured 136 tons of gold, the highest volume since 1967 and the second highest since 1950, representing a 150% increase from 2021. Additionally, apex banks added another 137.5 metric tons to their reserves last year, marking the second highest annual purchase in history. The fervent gold buying spree has shown no signs of slowing down in 2024. The latest surge in gold prices has driven global official gold reserves to rise by a net 290 tons in the first quarter, setting a new record in the World Gold Council's data, which dates back to 2000. This impressive figure is 1% higher than the previous Q1 record of 286 tons set in 2023 and a staggering 69% above the 5-year quarterly average of 171 tons. Rick Rule, a highly esteemed investor, speculator, and founder of Sprott Global Resource Investments, forecasts even more thrilling developments in the precious metals and resource sector as retail investors begin to show renewed interest in gold and silver. Rick points out that retail investors, previously indifferent to gold and silver investments, are now recognizing the imminent downfall of the global debt-based fiat system. While this realization is unfolding slower than Rick would prefer, he is confident that the pace will quicken significantly in the coming years, benefiting tangible assets like gold and silver. In a recent interview with Jimmy Connor, Rick elaborates on central bank gold accumulation, emphasizing that apex banks, especially those in emerging markets, are purchasing gold to challenge the West's dominance and prepare for a new world order. In this emerging order, the global economy will be underpinned by tangible assets like gold and silver, which have safeguarded investors for millennia, rather than by easily inflated fiat currencies like the US dollar. He uses the US economy as an example, noting that despite its status as a global superpower and the issuer of the world's reserve currency, it is heavily indebted and on the brink of a severe collapse.
I think it comes to two general things. First is the weaponization of the US dollar. The US government has decided, in their wisdom, by the way, whether or not you agree with US policy, to export US policy to other countries who may have their own agendas. The weaponization of the SWIFT banking system, which is not US property, but the US government has decided to do anyway as a consequence of the fact that it's denominated in US dollars. And further, the theft by the US government of $300 billion worth of Russian holdings of US treasuries. Again, whether or not you agree with Russia's policy or America's reasons to do so, has caused governments around the world who believe that they might come into the sights of the US government. As an example, the Russians, the Chinese, the Indians, the Saudis, to question their holdings of US Treasury securities and their use of the US dollar for international trade. A second problem, I think, is that the arithmetic around US Treasuries has gotten worse and worse and worse. We came through a period really of US dollar hegemony. I would suggest in the period 1982 to 2022, the internationalization of the US dollar and the decline in both nominal and real interest rates were tailwinds for gold. Now, I think that foreign countries in particular that look at the US dollar and look at US treasuries see an instrument which pays them 4.3, 4.5%. I'm talking about the US 10-year, in a currency where, separate and apart from the CPI, they see the purchasing power of the currency decline by 7 or 8% compounded. And so they're stuck with this sort of a conundrum. You invest in an instrument which gives you a negative real rate of return, and you do so while exposing yourself to the risk of the extraterritoriality of US policy. It's a real lousy bargain for those countries. It can't be any surprise that the Chinese, as an example, have reduced their holdings of US treasuries by about 70%, pardon me, over the last 5 or 6 years. In the first instance, they think that investing in their own economy and in their Belt and Road strategy around the world yields higher real rates of return than they would if they were invested in US Treasury securities. And they also allow themselves to escape, at least in some sense, the extraterritorial imposition of US policy through the US dollar. So it's no particular mystery as to why foreign holdings of gold have increased and foreign holdings of US treasuries have decreased.
Well, that's what central banks are doing now. You made mention of the fact that investors, both institutional and retail investors, are not participating in the purchase of gold or gold equities. Why?
Not to the, well, in the last 5 weeks, my evidence comes from the ETF holdings. They have begun to participate. Why they didn't participate before is a matter of conjecture. My conjecture would be that gold is an instrument that reacts to fear. And we've lived through 40 pretty benign years, going back to the beginning of the lowering of the US interest rate in 1992, all the way through 2022. Stock market was up, the bond market was up, there was lots of liquidity. I'm not trying to say there weren't some punctuations, 1987, 2008. We had some pretty dramatic punctuations, but the lessons that we learned as investors in those punctuations were that you'd buy the dips. The truth is that people were pretty optimistic because financial markets were continuing to do well. This reminds me a bit, frankly, of the late 60s and early 70s, when all of the indications of inflation were in the system, but people hadn't experienced it yet. They'd lived through 2 benign decades after the end of World War II. And while people read about inflation, it wasn't until they had sort of 5 years of experience with inflation. It wasn't until they'd seen the price of gas at the pump go from 20 cents a gallon to $1 a gallon, as an example, that they began to internalize the lessons. And I believe that the same process is underway right now.
Rick Rule and several other financial analysts and commentators highlight a prevalent issue: recency bias. This cognitive bias leads decision-makers and the general populace to overemphasize recent experiences or the latest information when predicting future events. As a result, people tend to believe that current situations and trends will continue indefinitely, overlooking the possibility of disruptions similar to historical events. Experts warn that this bias will cause many Americans to be misled into thinking the economy is stable, only to realize the truth when it's too late to take corrective action. Historically, all strong economies eventually collapse, and every superpower loses its dominance to another. In the modern era alone, various dynasties and empires, from the Spanish to the British, have risen and fallen. It would be extremely arrogant to assume that the US can maintain its global supremacy forever.
My belief is that after 3 years or 4 years or 5 years, people will begin to understand the price that they pay for the diminishment of the purchasing power of the dollars that they earn working or in their savings. I suspect that you'll look at the CPI, which suggests that, quote, inflation is moderate at 2.6%. But you'll look at what happens to the basket of goods and services that you purchase. that impacts your lifestyle. And you'll say, wait a minute, the purchasing power of my dollars isn't decreasing by 2%. It's decreasing by 7% or 8%. And if you experience that over 5 years, if you watch your rent, as an example, if you were a renter, increase by 6 or 7% compounded. If you watch watch the cost of a shopping basket full of groceries increase by 100% over 4 years, all of a sudden you come to the same conclusion that retail investors came to in 1972 and 1973, which is to say, all is not well. And I think it's that consciousness that really kicks off a market in the metal. And let's talk about one other thing while we're at it, which is to say the probability of increases in the future. I don't want to give you a Canadian number because I don't know it. But in the US, the on-balance sheet liabilities of our government exceed $34 trillion. The off-balance sheet liabilities, though, Medicare, Medicaid, Social Security Trust Fund, military pensions, government pensions, all that kind of stuff, exceed, according to the Congressional Budget Office, $100 trillion. And we propose to meet these obligations with a budget that goes further into deficit by $1 trillion every 100 days. Now, how do we get ourselves out of this conundrum? Understanding that America's GDP is under $30 trillion, which is to say our GDP is less than our on-balance sheet liabilities and is 20% of a combination of our on-balance sheet and off-balance sheet liabilities. How do we solve this? Well, they say, tax the rich. Top 1% of Americans have an aggregate net worth of $5.8 trillion. If you stole the entire net worth of the 1% in the United States, you wouldn't have solved the debt. What you would have done is funded, something like 20 months of the deficit. How about curtailing benefits? Let's say to the old guys like me, hey, Rick, you voted yourself a whole bunch of cool benefits for 40 years. You forgot to pay for them. We're not going to give you the money. You follow me? There's a whole bunch of hard choices. And you know what? We faced those hard choices before. Not as hard, but we faced them in the decade of the 70s. We had unsustainably high debts. We couldn't raise taxes. So what did we do? We inflated away the real value of the obligations. The purchasing power of the US dollar over the decade of the 70s declined by 80%. So we didn't renounce the debt in the honest, old-fashioned way by saying, yeah, we owe, but we ain't going to pay. Too bad, too sad. What we did is we made the debt less important relative to the inflated dollars that we took in via taxation. So my suspicion is that the way that we deal with this $130 trillion obligation or series of obligations is that we, in effect, inflate away most of the present value of the obligation.
Rick Rule believes that in 3 to 5 years, people will wake up to the harsh reality of diminishing purchasing power. While the CPI may suggest a moderate 2.6% inflation rate, the true story is told by skyrocketing costs of everyday goods and services. Imagine your rent climbing 6% every year and your grocery bills doubling in just 4 years. This eye-opening realization, much like the one experienced in the early 70s, will likely drive a surge in the metals market. The U.S. government's financial situation is staggering, with liabilities exceeding $34 trillion on the balance sheet and off-balance sheet commitments like Medicare, Medicaid, and pensions adding up to a colossal $130 trillion. With a GDP under $30 trillion, the only feasible solution appears to be inflating away the debt, echoing the 1970s strategy when the dollar's purchasing power plummeted by 80%. Rick outlines 3 potential paths forward: continue excessive money printing and debase the dollar, hike taxes, or slash spending drastically. However, it seems the chosen route is endless borrowing, risking the dollar's value. This is why Rick and others champion owning gold and silver as a way to safeguard and preserve wealth. Intrigued? Dive into Rick Rule's full interview where he breaks down these complex issues and offers valuable insights into the future of the U.S. economy. Your financial future might depend on understanding these dynamics. What are your thoughts on Rick Rule's analysis? Share your comments below, and don't forget to like this video, subscribe to our channel, and hit the notification bell for more insightful content. Thanks for watching and stay tuned for more.